This extremely simple trading system is the reason I've been able to do things like this and also this within the last couple months alone. And I'm going to show you exactly how to do it by explaining the system, but also backtesting with you to show you how easy it is to replicate. And at the end of this video, I'm going to give you a trial into my group so you can watch me live execute these same principles in the live markets. Step one is trading during the correct time. As a volume trader, I am only looking to trade during periods that statistically have the highest volume. And the period where the most volume in the markets is usually during major session open times. Well, I myself trade New York Stock Exchange Open, which is during 9:30 a.m. Eastern Standard Time, so I'll be using that as our trading window during our backtesting session later on. But if you plan to trade any other session, that's also completely fine. I have a course that breaks down the best assets to trade during the correct session, and it's all completely for free. So if you go to the description and join my free group, I have tons of free education for all levels of experience. Okay, so this is US 30. These boxes that you see indicate the first couple hours of major session open. So as you see, statistically, during these times is the periods of the most volume. But when you mix in trading the correct asset during the correct time, which is here trading US 30 during the New York Stock Exchange Open, you can see that volume is even higher during that set period of time. So look at New York session here. Statistically, is always going to have a lot more volume with USD based pairs than London and Asian session. And we can go back. New York is the one that's not labeled. London and Asian are labeled. We can go back, and statistically, New York is always going to have the highest volume. So I myself only trading USD-based pairs and USD indices. I'm only going to be trading New York Open during this backtesting session, and you will see how high of a strike rate we can get by simply just merging technicals with the correct time aspect of trading during session open. So step number two, as we spoke about, is a two-part system. The first part of the system is what is the current trend? Just simply meaning, are we creating higher highs and higher lows, or are we creating lower highs and lower lows? The easiest way to do this without getting too confused is by going to an ultimate low and then starting from the nearest structure from that point. So here we have a lower high sitting up here, and we have a lower low sitting all the way down here. And I'll kind of mark this out with the path tool just in case this doesn't make much sense to you guys. We had a good push lower here, we had a good retracement, and then an expansion all the way lower to create new structure. And so as long as price is within this lower high and lower low, we expect price to more often than not go in the direction of trend until it breaks that structure, which it ends up doing all the way up here. And then from this point, as soon as we break above these structure points, we're simply moving our line here to the next high, moving our line here to the next higher low, and we're playing off of this newfound structure all the way until it breaks, which I'll mark out here. Okay? So as you see here, price came all the way down for about 100% retracement twice, never closed below, and ended up continuing higher up to new highs all the way up here. And we're simply just moving our structure here. Higher high, higher low, bring up your arrow, and until we break below this higher low point here, we simply expect price to more often than not travel within the direction of trend, which in this instance is bullish, okay? So that is part number one, is finding out, is price creating lower highs and lower lows for a bearish market, or two, is price creating higher highs and higher lows for a bullish market. And then the second part to this equation is, what are we currently reacting off of on the 4-hour time frame? So support and resistance and trend when it comes to this higher time frame bias is always going to be on hourly and 4-hour time zone. Okay, so here we are on the 4-hour time frame. We want to squeeze price as tight as we possibly can, and we want to look for major reactions close to where price is currently at as an area of interest to potentially trade off of. This is structure. And so when we come up here and grab our rectangle box, we want to drag price from one high that has a major reaction from it, push it to the future, and see if that holds true every time it comes back to revisit this area. And when I say major reactions, I'm saying at least 1,000 points when we come up to these areas. Like for instance, this break below was 3,500 points. Once we came back up to revisit this area, we ended up rejecting almost 1,000 points. And once we came down to retest it, look at our pushes up. First one was 1,600. Second one was 1,100. Third one was 1,000. Fourth one was 1,300. Fifth one was 1,000. And the sixth one was 1,400. Mega moves every time we come up to this market. Now, as long as there are 3 or more reactions to this area of interest, we can use it as part of our buy. So let's go ahead and check and see how many reactions we have. We have one reaction here. We have a second reaction here. We end up breaking above with a ton of volume, retesting this area, and then pushing higher for a third reaction. And now anything beyond this point can be used as part of our bias going into the future. So we could potentially capitalize off of bias here, 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 and here, depending on if the time aspect was correct, and obviously if we have confluence on lower time frames. And so now going into today, now that we've already found out that we're creating higher highs and higher lows, going to what area we're currently reacting off of, we're also currently reacting off of support. So not only are we creating higher highs and higher lows, we're also currently reacting off of support, telling us that there's multiple indications telling us that price is probably going to continue higher for this day. And that's what's going to lead us into the third step, which is going to lower time frames to figure out how we can actually enter based off of this bias. So very first thing I'm going to do is run you guys through an example on the slideshow, and then we'll run through two examples on the actual charts themselves. So very first thing is wait 5 minutes before session open. You don't want to go any further back than that because there's multiple highs and lows that are always being violated during this time. So 5 minutes before session, and we're going to mark out our most recent support and resistance. Now, one key thing to remember here is our bias from step 1 and step 2. If we have a bullish bias, we only want to look for buys, a break above resistance. But if from step 1 and step 2, if we have a bearish bias, we only want to look for sells, which is a break below support. So mark out your most recent resistance if it's for buys, which is for this scenario here, or mark out your most recent support if it is for sells. And as soon as session opens, and not a minute before, as soon as we break above or below that area based upon your bias, go ahead and enter into the market. So in this example, as soon as we broke above resistance, we went ahead and entered the market, and then we're mechanical from this point. So as soon as a 1 to 3 gets hit, remove yourself from the market, and either that or stop loss is going to hit. Now what you're doing with this is you're giving yourself higher confluence trading by having multiple confluences before you get into the trade. But number 2, by risking for higher R to R, risk to reward, what you're doing is allowing for yourself to be incorrect more by chasing a higher reward. Versus a 1-to-1 trader, your strike rate has to be a lot higher because you're simply only risking 1 to make 1. And this is extremely key within the system because if you go through any periods of loss, having that higher risk to reward per trade is what's going to pull you out of it and ultimately keep you green within a month-to-month basis. Okay, the last thing we're going to be talking about in this video is how to correctly size your stop loss. So I use the ATR to correctly size my stop loss every single trade. What the ATR is, it's an average range of each individual candle over a set period of time. So I myself, I use a 20 length ATR, which simply means that over the last 20 candles, whatever that number the ATR is showing, that is the average range that each individual is printing, which is good for our stop loss. It simply means that if price starts to go further than that range over the past 20 candles against us, it's a good indication it's probably going to continue onwards in that direction. So we remove ourselves from the trade. And so how I use this is going down to the 5-minute time frame. And if the ATR, whatever the ATR is reading, we're going to round down and use that as our stop. Reading 25, we're going to use a 20-point stop loss. Or if the ATR is reading something like 43, we'll be using a 40-point stop loss. So if you guys want to see exactly how that indicator looks, I'm going to go ahead and show you real quick on the chart. Okay, so this is how that indicator looks on the chart. Up here, you see the ATR is 41 on the 5-minute time frame. And so for the last 20 5-minute candles, each individual candle on average is printing about a 41-point range. And so when we use our stop loss and put up our position here, we would simply be using a 40-point stop loss within that trade. If you would like this indicator for yourself, I have the link down in my description to join my free group. And from that point, there's multiple resources, including a free course to show you guys exactly how I navigate the markets.